Dear SBR and FR students, I am Abeel Ahmed, SBR and FR expert. In today's concept building video, we'll be discussing something very interesting from IAS 12. Let's begin that concept. For that, I need one note so that I can explain it to you. Just a minute. Now listen, students, carefully. Assuming your organization has bought a land on 1/1/2026, the value of the land is 800,000. Number one. Number two, your company is using IAS 16 property plan and equipment and a revaluation model. Okay. At the end of the year, the same land becomes $1 million. Okay. Now the fair value of that land is $1 million. It means you have recognized a revaluation surplus of 200,000. So the carrying amount of your land at the end of the year, the carrying amount of the land becomes $1 million. But when it comes to tax base, things are very interesting. When it comes to the tax base, according to taxation authorities, they do not accept revaluation surplus. According to the taxation authorities, the tax base is the original cost of the land, which is 8 lakh. Okay, temporary difference. You will be having a we are having a temporary difference of 200,000, and this temporary difference is a taxable temporary difference, because in case of assets, when carrying amount is more than the tax base, difference is a taxable temporary difference, and taxable temporary difference multiplied by tax rate, you will have a deferred tax liability. Assuming the tax rate is 30%, here comes a deferred tax liability which is 60,000. Okay, obviously organization will have to recognize a deferred tax liability of 60, but the interesting part is, where would I charge this deferred tax liability? Should I charge this to P&L or should I charge to somewhere else? The answer is, according to IAS 12, of course you have to concentrate. You need to know the reason that why this deferred tax liability is arising. If this deferred tax liability is arising from an equity item, it should be charged to equity. Here in our example, logically this deferred tax liability is arising because of the revaluation surplus. So this deferred tax liability should be charged to revaluation. The double entry is, we are going to debit the revaluation surplus slash OCI slash OCE, but we are going to credit the deferred tax liability. So here actually we will be in easy wordings, in simple wordings, we are going to reduce your revaluation surplus by 60,000. So if your liability is arising from equity item, we are going to charge this to your equity. So simply, the double entry of this deferred tax liability is going to be, we are going to debit revaluation surplus OCI, OCE, other component of equity by 60,000. We are going to credit your deferred tax liability. So don't forget the concept. If your deferred tax liability is arising from equity item, you have to charge that to equity. And look at this, one more thing that will really help you. In case of assets, carrying amount is more than the tax base. Difference is a taxable temporary difference. And taxable temporary difference multiplied by tax rate, you will get a deferred tax liability. In case of assets, if the carrying amount is less, tax base is more. Okay. The difference is a deductible temporary difference, and deductible temporary difference multiplied by tax rate, you will get a deferred tax asset. In case of liabilities, the relationship is exactly opposite. It means in case of liabilities, if the carrying amount is more and the tax base is less, okay, now difference is going to be deductible, and deductible temporary difference into tax rate, now we are having a deferred tax asset. For example, IAS 37 provision, there is going to be a carrying amount of provision, but tax base will always be zero. So in case of provision, carrying amount is higher, tax base is zero, you will be having a deductible temporary difference, and deductible temporary difference multiplied by tax rate will give you a deferred tax asset. So in case of liabilities, the relationship is opposite. In case of liabilities, if carrying amount is less and the tax base is more, that is very interesting. In case of liabilities, the carrying amount is less, tax base is more, the difference is going to be a taxable temporary difference, and taxable temporary difference multiplied by tax rate will get a deferred tax liability. The question is, How it is possible that liability is having a carrying amount lower than the tax base? It is very much possible. Let me give you the example. Let's talk about compound financial instrument IAS 32. In compound financial instrument IAS 32, what happens? If your company has issued a convertible bond, then it is your responsibility to split that compound financial instrument into debt and equity component. Assuming your company has issued a compound financial instrument and your company has raised the amount of 100,000. So when it comes to debt, I'm assuming that you have calculated the debt component, which is 90,000. Debt component is 90. But when it comes to tax base, according to the taxation authorities do not split the compound financial instrument into debt and equity. Actually, taxation authorities, they see the entire component as liability. And your company has raised 100,000, so the tax base is 100,000. In my books, the carrying amount of the liability, the carrying amount of the debt component is 90,000, but the tax base is 100,000. Now I'll be having a taxable difference of 10,000. Multiplied by tax rate, we are having a deferred tax liability. But a very interesting point is, this deferred tax liability is again arising from equity item. Now here this deferred tax liability is arising from equity item, so it will be charged to equity. But here the double entry of this 3,000 will be, we are going to debit OCE. Other component of equity we are going to debit, and deferred tax liability we are going to credit. So this is the example where you are having a carrying amount of liability lower and the tax base is higher. In case of compound financial instrument, let me repeat it for you. If your company has issued a compound financial instrument, it is your responsibility to split that into debt and equity component, assuming the debt component's carrying amount is 90,000. But when it comes to taxation authorities, they see the entire component as a liability component. So tax base is 1 lakh. So day one, the taxable temporary difference is 10,000. Multiplied by tax rate, you will be getting a deferred tax liability. And now the double entry is, other component of equity is going to be debited, and we are going to credit the deferred tax liability by 3,000. After that, we know that slowly and gradually that debt component, due to unwinding of discount, will keep increasing, number one. And number two, slowly and gradually the taxable difference will also keep reducing, because the carrying amount of the debt component will keep increasing due to unwinding of discount. Then slowly and gradually, your taxable difference will keep reducing, because tax base will remain same every year, but carrying amount of the debt component will keep increasing. So the slowly and gradually your taxable temporary difference will reduce and your deferred tax liability will also reduce. But subsequently, when there will be a reduction in the deferred tax liability, that reduction in the deferred tax liability will take it to the P&L. Why we are going to take that reduction in the liability to the P&L? Because what is the reason that in the future we'll be having a reduction in the deferred tax liability? The reason is the unwinding of discount, which is a finance cost, which is a P&L item. So logically, subsequently, that P&L item is going to bring a reduction in the deferred tax liability. That is where reduction in the deferred tax liability will take it to the P&L. So students, that is all about IAS 12. And don't forget one concept: when your deferred tax liability is arising from equity items, so it will be charged to equity. So thank you very much for watching this concept building video. And students, don't forget to get benefit from our FR crash course, number one. And number two, in SBR, we have launched 2 types of crash course. One is, you can revise all IASs and IFRSs just by spending 8 to 9 hours. Second, there is a 7 hours crash course on consolidation in SBR. By spending 7 hours on consolidation, you can have an excellent grip. In consolidation crash course, in first 2 hours, I have explained all the concepts, and the remaining 5 hours, we have covered 5 latest past paper questions on consolidation. So students, thank you very much for watching this concept building video. Have a nice day. Thank you.